The morning star and the evening star are the last two candlestick patterns we will be studying. Before we understand the morning star pattern, we need to understand two common price behaviors: gap up opening and gap down opening. Gaps are a common price behavior. A daily chart gap happens when the stock closes at one price, but opens on the following day at a different price. Gap up opening. A gap up opening indicates buyers' enthusiasm. Buyers are willing to buy stocks at a price higher than the previous day's close. Hence, the stock opens directly above the previous day's close because of the enthusiastic buyer's outlook. For example, consider the closing price of ABC Limited was 100 rupees on Monday. After the market closes on Monday, assume ABC Limited announces their quarterly results. The numbers are so good that the buyers are willing to buy the stock at any price on Tuesday morning. This enthusiasm would lead to the stock price jumping to 104 rupees directly. This means there was no trading activity between 100 rupees and 104 rupees. Yet the stock jumped to 104 rupees. This is called a gap up opening. Gap up opening portrays bullish sentiment. In this chart, the green arrows point to gap up openings. Gap down opening. Similar to gap up opening, a gap down opening shows the bears' enthusiasm. The bears are so eager to sell that they are willing to sell at a price lower than the previous day's close. In the example stated above, if the quarterly results were bad, the sellers would want to get rid of the stock, and hence the market on Tuesday could open directly at 95 rupees instead of 100 rupees. In this case, though there was no trading activity between 100 rupees and 95 rupees, the stock plummeted to 95 rupees. Gap down opening portrays bearish sentiment. In this chart, the green arrows point to a gap down opening. The morning star is a bullish candlestick pattern which evolves over a 3-day period. It is a downtrend reversal pattern. The pattern is formed by combining 3 consecutive candlesticks. The morning star appears at the bottom end of a downtrend. In this chart, the morning star is encircled. The morning star pattern involves 3 candlesticks sequenced in a particular order. The pattern is encircled in the chart above. The thought process behind the morning star is as follows. The market is in a downtrend, placing the bears in absolute control. The market makes successive new lows during this period. On day 1 of the pattern, as expected, the market makes a new low and forms a long red candle. The large red candle shows selling acceleration. On day 2 of the pattern, the bears show dominance with a gap down opening. This reaffirms the position of the bears. After the gap down opening, nothing much happens during the day, resulting in either a dodgy or a spinning top. Note the presence of dodgy spinning top represents indecision in the market. The occurrence of a dodgy spinning sets in a bit of restlessness within the bears, as they would have otherwise expected another down day, especially in the backdrop of a promising gap down opening. On the 3rd day of the pattern, the market stock opens with a gap, followed by a blue candle that manages to close above P1's red candle opening. In the absence of P2's dodgy spinning top, it would have appeared as though P1 and P3 formed a bullish engulfing pattern. P3 is where all the action unfolds. On the gap-up opening itself, the bears would have been a bit jittery. Encouraged by the gap-up opening, buying persists through the day, so much so that it manages to recover all the losses of P1. The expectation is that the bullishness on P3 is likely to continue over the next few trading sessions, and hence one should look at buying opportunities in the market. Unlike the single and two candlestick patterns, both the risk taker and the risk-averse trader can initiate the trade on P3 itself. Waiting for a confirmation on the fourth day may not be necessary while trading based on a morning star pattern. The long trade setup for a morning star would be as follows. Initiate a long trade at the close of P3 after ensuring that P1, P2, and P3 together form a morning star. To validate the formation of a morning star on P3, the following conditions should satisfy. P1 should be a red candle. With a gap down opening, P2 should be either a doji or a spinning top. P3 opening should be a gap up, plus the current market price at 3:20 p.m. should be higher than the opening of P1. The lowest low in the pattern would act as a stop loss for the trade. The evening star is a bearish equivalent of the morning star. The evening star appears at the top end of an uptrend. Like the morning star, the evening star is a three-candle formation and evolves over 3 trading sessions. The reasons to go short on an evening star are as follows. The market is in an uptrend, placing the bulls in absolute control. During an uptrend, the market stock makes new highs. On the first day of the pattern, as expected, the market opens high, makes a new high, and closes near the day's high point. The long blue candle formed on day 1 shows buying acceleration. On the second day of the pattern, the market opens with a gap reconfirming the bull stance in the market. However, after the encouraging open, the market stock does not move and closes by forming a dodgy spinning top. The closing on P2 sets in a bit of panic for bulls. On the third day of the pattern, the market opens gap down and progresses into a red candle. The long red candle indicates that the sellers are taking control. The price action on P3 sets the bulls in panic. The expectation is that the bulls will continue to panic, and hence the bearishness will continue over the next few trading sessions. Therefore, one should look at shorting opportunities. The trade setup for an evening star is as follows. Short the stock on P3 around the close of 3:20 p.m. after validating that P1 to P3 form an evening star. To validate the evening star formation on day 3, one has to evaluate the following. P1 should be a blue candle. P2 should be a doji or a spinning top with a gap up opening. P3 should be a red candle with a gap down opening. The current market price at 3:20 p.m. on P3 should be lower than the opening price of P1. Both risk taker and risk averse can initiate the trade on P3. The stop loss for the trade will be the highest high of P1, P2, and P3. Before we conclude this chapter, let us summarize the entry and stop loss for both long and short trades. Remember, during the candlestick study, we have not dealt with the trade exit. We will do so in the next chapter. Risk taker. The risk taker enters the trade on the last day of the pattern formation around the closing price. The trader should validate the pattern rules, and if the rules are validated, then the opportunity qualifies as a trade. Risk averse. The risk-averse trader will initiate the trade after he identifies a confirmation on the following day. For a long trade, the candle's color should be blue, and for a short trade, the candle's color should be red. As a rule of thumb, the higher the number of days involved in a pattern, the better it is to initiate the trade on the same day. The stop loss for a long trade is the lowest low of the pattern. For a short trade is the highest high of the pattern. Thank you for watching this video. If you have any doubts or questions related to trading, feel free to reach out to us on WhatsApp at this number. And if you haven't subscribed to our channel yet, please consider subscribing. We'll be back soon with another insightful trading lesson. Until then, have a wonderful day.